So we stopped the bleeding this week and got the long lower shadow that we were anticipating the past couple of weeks. Is this was Monday the day, the reversal bottom, the day that nobody wanted to buy? I'm going to break down the technicals, what they're showing, and what we should expect to see early next week into the end of next week and beyond, based on the market forecast indicator as well as other indicators. So let's go ahead and get started. Today is Friday, November the 2nd, 2018. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's take a look at the S&P 500 first with the market forecast indicator. It's actually this chart here. And we can see, we had a down day today, obviously. In my classes on Thursday night, and we talked about in the portfolio management class, we have a class where I teach you how to manage a portfolio, kind of a bigger portfolio with ETFs that you can then be more active with, but kind of this is the big portion, the more passive portion of your portfolio. We talked about how to recognize, first of all, what to expect in the short term. We said that, if not today, then Monday or Tuesday, we're going to get a near-term pullback where that blue line starts to pull down. It usually doesn't stay, the blue line doesn't stay above 50, that's 7 to 12 days. I think I mentioned it here before as well. That idea, and so that's what we talked about on Thursday night in our premium class, and it started today, so just like clockwork. The question is going to be that near-term line is going to drop below 50. We need it to drop below 50, which means the market's got to pull back in the near term. It's not a bad thing. The question is, where is it going to pull back to? Right, we have a rising intermediate line, but it's still weak, which means that those near-term runs don't last a typical 7 to 12 days. So once it pulls back below 50, how far down does it go? We don't want it to get too far, if not at all, below 20. Preferably not at all. It might tip its toe underneath there because of how high volatility is. But we don't want it to get down too far. We want it to get below 50 but stay above 20 and then bounce right back above 50 after like a day or two with a low point on the S&P that's higher than the last one. This one. Here's our last near-term low point, right? This dip below 50 that started right here where my cursor is and lasted this whole time. So that was, this dip was a near-term dip, and so there's your low. So if we get a near-term low that's higher than this one, then we have a bullish near-term low, then we would expect a bullish near-term high. See, this near-term low was lower than the last one. So we want the next near-term low to be higher than this one. Obviously the near-term high is obviously lower too, so we're not on a bullish trend right now. But if we get a higher low, then there's a good chance we'll get a higher high along with it. So, that's kind of how we're looking. We also talked about in our class how to recognize when these expectations for a bullish market, for a bullish long-term moves, transition to more bearish ones, right? It's one thing to get a 4-week decline of 10%. That's very, very quick, very rapid, and in the past has shown that unsustainable long term, right? Then it's quite another thing though to get the 50-day to cross below the 200-day moving averages, to get a death cross that lasts for months. See, we didn't even get it to last for months in 2015 and 16, right? It had a little brief period at the end of 15, brief period at the beginning of 16, but then we took off again. So very similar, in my opinion, to what's going on right here. So we expected to pull back. It started that pullback today. It's not done, right? So expect more weakness maybe Monday and Tuesday, enough to bring the blue line below 50. But ideally not enough to get below 20. Now, if it gets below 20, like this one over here, or this one, or this one, if it gets below 20, then there's a pretty good chance the intermediate line will roll back down too. I don't expect us to get to new lows. At least below this week's long lower shadow. I don't expect that, but as you'll see on the weekly chart, but I do expect that we'll be staying in this range for a while if the near-term line gets below 20 again. If it dips below 50, 1 or 2 days, bounces right back up, great. If it pulls back below 20, probably going to be hovering in this area for a little bit longer than we want. Now, I don't expect that because of the seasonality, but it doesn't mean it can't happen. Right, it doesn't mean it can't happen. If you look at the Dow Jones Industrial Average, very similar pattern, weak bullish posture, near-term line starting to drop. The NASDAQ Composite, same thing, a little bit of a Harami pattern. and then you got the little island doji on the Russell 2000, which has been a little bit more bullish, but finally got the near-term intermediate line up above 20. So it's been lagging. It's bullish. It's been lagging though, so its near-term line hasn't started to pull back yet. So again, watch. And remember, again, the rarity of getting a cluster of clusters last time was March 2009. So kind of gives you an idea about how bearish that move was on the Russell. Alright, quick break before we look at these other charts. Remember, watching our Market Outlook video on our blog, let us know you want us to keep doing these videos. You can do that with 3 clicks. 1, click this heart right here on the today's Market Outlook tweet, then click that like button. 2, click on this little image here. It takes you to your Facebook page where you can click the like button there. And then 3, on our blog itself, click on that button. So those 3 clicks tell us you want us to do these videos. If you don't want to do these videos anymore, then don't click on any of those 3 things. Also remember too, you can discuss today's market outlook with other market scholars in the forums. Click that link there. It takes you to our forums where you can create new topics by scrolling down to the bottom and then hit submit. Remember, you have to subscribe to do that. You can do that for free by clicking this image up here under Join Market Scholars. It takes you to this page. Just fill out that form and hit sign up. Remember, you have to click on that. You have to read and agree the terms of service right there. Also, too, here's our upcoming class schedule. I do have that Q&A tomorrow morning that we do on Saturday mornings, and then here's our Monday classes. 2 of our really popular classes that Brandon teaches on Monday. Also, really quickly, subscribe to our YouTube channel. Click that mouse over this Market Scholars logo right there in the bottom right corner of your screen. Then hit that red subscribe button that pops out. Also, click the thumbs up icon that's down below the video. That's another way to tell us you want us to do the video again Monday. If you don't, then don't click that thumbs up icon. Comment down below, further below, on anything that stands out to you on the blog or on YouTube. Join our daily Market Outlook email list. There's a link popping out in the top right corner of your screen. Click that link to subscribe to our list. Really easy way to do that. Follow me on Twitter for more content like this throughout the day, me and Brandon, as well as our Market Scholars page. And then finally, join our Market Outlook community that we created on Facebook. All right, now let's take a look back at these charts, and you can see long lower shadow alert, right? The long lower shadow we've been looking for. It got to a new low. It got to a low point that nobody wanted to buy. I mean, everybody in the world is bearish. When everybody in the world is bearish, then that's a good sign, right? That's actually a really good sign for stocks. It's the tug of war that's the concerning part, right? That's a normal market. But when the market gets completely one-sided, in this case, sometimes it gets completely one-sided to the upside, that's a bad sign. For a reversal. In this case, it was a bad sign. In this case, it's a bad sign for bears, right? True shorts and bears do not want everybody to be bearish, because then there'll be nobody left to sell, right? Everybody would sell. It would tank the market as it did in such a short period of time. Nobody's left to keep selling, and we bounce, and people start covering shorts rapidly, especially these institutional traders once they start seeing some decent values. So we did bounce back up towards the 200-day moving average. Did not quite get back above it. We did close back above the 2700 level. Important because that kind of nullifies the breakdown. See, there's your 2700 level, this old intermediate low point. We broke down below that low point here, but got right back up above it this week. So a little bit of a fake out there, which tended to be bullish as well. You can see the Dow stayed above the 200. Look at that long lower shadow on the NASDAQ. And then your big Russell 2000 tweezer kind of bottom there, similar to this kind of a move that you see on the Russell. So it's below the 200-day moving average, but a bullish pattern nonetheless on the weekly chart. So if you look at the 3 green arrow charts, you'll see, of course, 2 green arrows in the MACD and stochastics. You'll see that the MACD hat and stochastics have both crossed their moving averages. They're both rising. They're still weak positions. We did hit the 17-day for resistance. That's like your next layer. When you hit the 8-day, you'll hit it again, and eventually you'll break the 8. See, the stages of a bullish reversal are to break the 8-day moving average, then to hit the 17-day for resistance in the short term, but then eventually break the 17-day, make its way towards the 30, and then then the 8 will cross the 17-day. That's what gets the blue line down here above 0. Then you get both of those lines crossing up above the 30. that's your stage. Those are your different stages. Right now we're in the second stage. We got above the 8. We hit the 17 in the short term. We're going to pull back a little bit in the short term, the next day or two. Then you would expect that we'll break through the 17 and help keep getting the blue line moving forward. Remember, it doesn't vacillate usually to the downside. Usually it grinds on the upside of this. It doesn't grind down here. Usually when you get deep low, it gets to 0 pretty quickly, as we've seen in the past. Now let's look at the intraday chart, and you can see we did get a higher high. We got up to the midpoint of the chart today, midpoint of the 4-week range, excuse me, and got right up to this week's open on the Heikin-Ashi candle. Again, for those that are unfamiliar, it's a weekly candle. You go to style, you change the chart type to Heikin-Ashi here, and you can see there's the open. It's actually an SPY. The open, see, when you get reversals, you'll start to get long upper shadows, right? When you start to see right there a smaller body and a long upper shadow after bigger bodies and no upper shadows is a reversal. So we've gotten bigger bodies. Let's see next week if we don't get a small body, which, you know, the open is the midpoint of this body. The close is the average next week of the high, open, high, low, and close of those 4 prices. So we won't get the close until the end of the week. But if it's a small body, see how these big, once you start getting small bodies with long upper shadows, then there'll be a good sign for reversal. You can see this week, if I were to get out my little trusty calculator here, this week's Heikin-Ashi open is 275.79. The close is 268.94. So divide that in 2. You add that to 268.94. So the midpoint is 272.36. So if I were to come over to the intraday chart and edit that to 272.36. This is going to be next week's Heikin-Ashi open, and you can see right now, today and yesterday we actually traded above that price. So we're a little bit below it as of right now, but that's going to be where it's at next week. You also see too, this is going to come off, so the dotted blue line is going to move down a little bit too. And you know, after a couple of days, it's really going to move down. So we're going to get to the point, depending upon how much we trade in this area in the near term, in the next day or two, we're going to get really close to the point where we can trade above the purple and that blue dotted line. And of course, the brown line is last week's high and low. So, you know, that's going to move down to, you know, this week's high is today's high. So that brown line is going to move there. So while we held all 3 of those lines for resistance this week, really good chance, because they're moving down, that we'll get above those 3 lines next week. And once you clear those 3 lines, all that open space is now available to trade on. All right, let's take a look at the what today's volume was, and you can see the trading range was a little bit above average, 5 points. It's still at the high end of the 52-week range, the 52-week average range. 5.64. You can see the volume again, 122 million, but back below the average. That's 3 days in a row of below average volume. So there's the ATR still relatively high. We never did peak above 2%. That's getting above 2%. That's when you're in bear market, right? So that's another sign that this is not a bear market drop. It's a big drop because it's big prices. It never did exceed the 2% level there on the ATR, and you can see the average volume, 122 million right here. So we've had multiple days now. The more as the volume tapers off and the trading ranges start getting below 5 and 4 and down to 3, you know, it'll eventually get down to these lower levels. Once these lines start falling again, then that's a sign the bottom's in, and we'll start grinding our way higher, just like we did over here. Once all these lines started to come back down, you see how we started to grind our way higher. Ups and downs as we did it, but we were grinding our way higher again. Alright, let's take now a look at the volatility index. On an absolute basis, you can see looks like we're forming a high point here, above 50 and above 0 on the MACD. That obviously is a lot higher. This one never did, you know, I guess it got to 53. There's your last peak right there. So this would be a lower high on volatility, and we're dropping below 20 on an absolute basis. On a relative basis, you can see we're still above 95. Remember, 95 will act as a support level, and so will 90. You break 90, that's when now the low point's going to hold, right? We formed a low point and volatility will continue to moderate. So expect us to get kind of up in this area again Monday, Tuesday, as we have some short-term weakness, but then reverse back down. Once you break these levels, that's kind of like the first step is, it's like stages again, right? Get back below the extremes, get back below 95, get below 90 is your last stage. Then when now volatility is in that bullish zone, bullish for stocks, bearish for volatility zone. All right, so to summarize, the markets are trying to figure out this low point. There's a lot of good signs in place coming off some extreme indicators of how oversold we were, but we were expecting some near-term weakness, and that continues to be the case heading into early next week. By the end of next week, there's a good chance a new higher near-term low can be set in, giving us one of those reversal candles on the Heikin-Ashi with a smaller body, a longer upper shadow, and potentially even breaking up into the upper half of the 4-week range, which we just haven't been in. A lot of stocks are starting to work their way themselves into their own, the upper halves of their own 4-week ranges. So things look to be moderating a little bit after the extreme selling. And now we see some opportunities developing, a lot of opportunities. So what do you think? Do you agree with that assessment, that outlook? Do you disagree? Let me know with that poll that's popping out right there in the top right corner of your screen. Click that link. It opens up a poll there. Hit either agree or disagree with this market outlook that we just summarized. If you click disagree, scroll to the bottom, either on the comment section of this blog or if you're on the YouTube page, and comment on anything that would tell you something different that you can share with the rest of our market outlook community. All right, now let's break down what's driving the price action today. Of course, early in the morning was the the idea that there might be a breakthrough in the trade talks between the U.S. and China. You can see emerging markets really took off on that. Obviously, and again, kind of shows you they've been the worst performer this year on all this trade talk mess and tariff mess, and you can see who would benefit the most. And you remember, the stocks went up this morning. So when these international stocks do better, they're going to lift us higher. There was a pullback. You can see by the middle of the day, the S&P was actually the worst performing asset class, including this morning's gap. Crude oil was down there. Long-term bonds really came down. They were the worst performer by the end of the day, again, which means yields really took off on the employment data. Really, really strong employment report. Continuing to look very strong for the market as a whole, for the economy as a whole. When you take a look at the chart of the jobs growth, it pulled back a little bit. Last year, there's your last October. It was a little bit higher. You can see some of these other Octobers, 1 in 15 got 350,000. So this is typically a pretty good month for jobs growth. So it brought the year-over-year figure down because of that, because we were a little bit lower. But you see the unemployment rate still very, very low. The inflation for average hourly earnings up over 3% for the first time since this recession started. So it brought the economic surprise index back to positive territory for the U.S. You see it's still not positive for globally. The GDP estimates have come out because there's other indicators too. Factory orders are out. Today they were up 0.7, beating the consensus. Not as high as it used to be, but the month before, but beating consensus. You can see the year-over-year growth rates remaining very high. These can't go up forever, so they will get to a point where they peak. The question is when and if they ever drop, and right now they're still maintaining strength of where they're at, and that's brought the GDP estimate for the next quarter to be right around that 3% level. So we'll see, how that emerges by the time we're all done. We still got 2 more revisions to the Q3 that just barely came out. So last week, remember we are now looking. December is the next rate hike is not as baked in the cake as it used to be, but it's it's starting to make its way higher again. So this would be another rate hike. This would be 225 to 250. There is no rate hike in December, so it's we have higher odds of not getting a rate hike in December It's above 20%, but still way below the odds of getting one. So you still have a really good chance of a rate hike in December. March is the question mark, right? March is the big question mark. It's always that second rate hike, and right now the odds of getting that rate hike. See, this would be where we're at right now. Would be, go back to December here. 225, 250 is where we'll get to. Where we're at right now is a 200, 225, the purple line. So go to March. These are basis points, right? So the purple line's down there where we're at right now. This would be the December hike, and this would be another hike in March. So briefly, that hike in March came down below the odds of no rate hike in March, just one in December, but it did bounce back up. They're still both very low. So, it's when you get above 60%, that's when you kind of clear a hurdle in terms of, okay, now we're most likely, this is all based on market expectations, but that's when you kind of clear a hurdle. If you look at December, we were below 60% for a while. Here, so the red line's the one. We were below 60% for a while as we were getting towards June. See, once you clear the June meeting, then December's the next meeting, right? It's September and then December. And so as we cleared the June meeting, the odds started to rise for December to get above 60. Once it got above 60, it kind of hit it for some support again, but it stayed up there and it's moved up towards 80 because that's the next hike. Now that we've cleared the September meeting, usually we kind of get above 80 at that point, as you've seen before in some of these others. So June, no one's really pricing in June right now. I remember, right, the current rate is 200 to 225. This would be December's in red. This gray would be a second hike after December, sometime before June. Good odds of that. And then this would be a hike in December, 275, 300 would be a hike in December, then March, and then June. And you can see it's still pretty high. It's relatively high, still low, not above 40 yet, but you probably won't get above 40 until until we get closer to the December meeting, and then we'll see if it takes off and gets above that 60% eventually. But odds on a long term, if you look at the long-term yield, let's go take a look at the rates, the weekly chart for the TNX, and you can see that's short-term rates. This is long-term rates, 3.2%, very high. You can look at the 30-year yield. It broke out to a new high today at 3.45%. Remember, these are not necessarily bullish or bearish to get these the rise in these rates. So here's 2000. In fact, I'll have to go a little bit further. We'll go as far back as we can. So here's where the stock market peaked in 2007, actually, and you can see throughout most of 2006 and early into 2007, yields were rising pretty high, and so was the stock market. The stock market didn't peak until late 2007. So we had gotten to a pretty decent level. The 30-year year got to a pretty, and at that point too. We were at 5.25% roughly. That's where the Fed raised rates in 2006. See, the Fed's not anywhere close to 3.5% right now. So there's a lot of room for this to grow with rising economic growth expectations, and for the Fed to get the overnight rate up anywhere close to 3.5%. We still got a long ways to go there. If you recall back in 2004, when the Fed rate, when the rate hike cycle started, this is when it started, was in June of 2004. The Fed rate was coming at 1%, and we were sitting at 5.5%. And so then the rates came down as the long-term rates were coming down as the Fed started raising rates. People were worried about economic growth and are we going to pump the brakes too much? Rates started to rise again, and then eventually by this point, so did the Fed funds rate, and they were both at equal levels. And there's your inversion in the bear market. And again, we're not to that level. We're not anywhere close to that level yet. All right, if you take a look at how the sectors are performing, you can see discretionary and financials held up today better, and so did there's discretionary financial, there's industrials and materials. And materials ended the week up 6%, including the dip. Initially dipped down, was at one point down 0.5% on that dip on Monday. But from the low point Monday going forward, You can see that your biggest winners were materials, up 7%, almost 7% off that low point. There's consumer discretionary. This line right here would be communication services. There's industrials. Technology and financials matching the market right around 4%. They're all both big sectors. And then there's your energy sector, energy materials up there. Lagging is utilities, down 1.5% this week. This would be your real estate sector that was flat this week. And then consumer staples up 1.5% in healthcare. So your safe haven areas lagging off of the lows. But you can see, at one point in time how strong some of these areas. I mean, up until today, because Apple really weighed on technology, but up until today, there's your technology, discretionary communication services, really leading the way while the market was up. With some of these other areas lagging behind. Financials did better today, so they bounced. Technology pulled back, but still matching the market for most of today's move. So you can kind of see that today's move was probably a lot of reaction to Apple, even with all this mess of China and all that, mostly a reaction to Apple there. So as I mentioned before, as we come off this lows, your sectors that are most likely to benefit early on at least will be those higher beta names: communication services, technology, discretionary. I don't expect that I expect materials, energy, and industrials to maintain outperformance if the dollar were to continue to work its way lower. You can see, after having kind of made a failed breakout move yesterday, the dollar, here, go back to DXY, the dollar had a little bit of a bounce today, but there's your breakout above 97, and then the fake out, right, the break right back down. So from a weekly chart standpoint, as you saw, it produced this little bit of a doji pattern here at DXY, a little bit of a doji pattern at resistance. We'll see if that ends up being the reversal. And if and when that does reverse down in the late cycle, an expected late cycle type move, energy, materials, industrials will be the leaders, along with these international areas that led from early 2016 on, when the dollar initially dropped, and then in 2017 to early 18 when it really dropped. All right, one stock that's Macy's here in that consumer discretionary area in the retail area hit a new 4-week high today after just about a week and a half ago forming a 4-week low. But we broke out through on Monday. We broke up through into the upper half of its chart, retested a couple of times, including yesterday before today's rally. If you take a look at its market forecast chart here, you can see you do have earnings that's going to be coming up here pretty soon on it. But you see how the posture has changed, the intermediate line's rising. This is all in anticipation, right, of that earnings coming up. You see the weekly and big bullish weekly candle back above the bouncing off the 200, back above the 50-day moving average. You look at the Bollinger Bands. You can see there's your earnings coming up here before November expiration, getting above the upper band, working its way in the upper half of the chart. There is some resistance in this area, not something to be completely bullish on, too aggressively bullish. And then finally the DMI, you can see for Macy's, the DMI positive, crossing above 25 after being extremely low here, below 10, working its way higher with a high ADX. You can see we haven't been this low in a long time, at least in the past 52 weeks. In fact, you'd have to go back a while for the positive, DMI positive, to get that low below. You can see it was right there. And even then, here, the orange line, the DI negative, got up above 40, and that wasn't the case here. So it shows that we're not as bearish now as we were even then. And then, of course, you had all these lines where you did have the orange line again above 40, and this one here. All of these were coming off of lower lows, sharp drops. Not such a sharp drop. Orange line stayed down. In fact, it didn't really even get above 30, much less 40. So good opportunity for a reversal pattern here on Macy's. And again, with that earnings coming up, we can look at the typical vertical setup because we don't want to be too bullish and manage the risk accordingly. So we'll look at the 30-31, your typical 30, mid-30s delta. Getting your pretty decent, probably a little inflated because of that earnings. So your position size around that 142 loss. Remember, cut that position size from normal down to a smaller size because of the increased risk factor of that earnings announcement coming up in case. And if that earnings leads us to a loss of $58 or more, so here's your 58 level, would be down into this area. We'd have to really get down here, down to 31 or below. So that basically nullifies this bounce and breaks us back down below this low. If that happens, we take that loss. We take a $58 loss per contract, if we can, and move on to some. We can take the full 142 with position size around it. Ideally, we want to take only 58 because that's all that we're trying to get. We want to match, try to match the profit with the loss that we're willing to take. All right, so that wraps us up for today, and a little bit of a change in format, especially at the beginning. I try to get right into the material, so let me know what you think about the new format in the comment section down there, about how quickly we're able to start talking about the market forecast, and then see if you like that little change and switch up. Also, let me know what you think about the market outlooks. Comment, hit that thumbs up icon, like the tweet, like the Facebook post. Let me know that you want us to keep doing these videos on Monday and every day next week. Love to hear your thoughts. So now is your time to let us know. Comment in the forums, open up new threads, reply to other people's threads. Let's keep this conversation going over the weekend. Have a great rest of your weekend, everybody. We'll see you all on Monday.